Let's get more from Brian Belski, Chief Investment Strategist at BMO. Brian, thank you very much indeed for joining us.
Thanks, Andrew. Good morning, Canada. Thanks so much for having us.
Let's start off with the TSX. You're restoring your year-end target of 28,500 for the TSX. So a bit of upside there. We are right now below 27,000.
Yeah, for 13 years now that we've had the pleasure to be at BMO and publish market targets for both the TSX and the S&P 500. Our predominant theme, Andrew, has been as America goes, so goes Canada. I know that's for some Canadians very hard to think about and ponder and understand right now, but given the fundamental complexities in relationship of both countries, number one, and number two, the 25-year secular bull market that we believe the United States stock market is in, as America goes, so goes Canada with respect to fundamentals. And Canada has been outperforming, which has been our published call out there in the universe since we published it first in May of 2024 that Canada was primed to outperform, and it's outperforming this year. However, going forward, we do think that outperformance will wane, albeit still very positive. So we think from a value and cyclicality basis, Andrew, Canada still affords global investors a great place to be, and especially those North American investors that can complement their U.S. holdings with Canadian stocks.
That's interesting. How do currencies factor much into your model there, Brian?
They do, but we like to stay in our lane in terms of our job. Our job as the chief investment strategist is to make people money with respect to their equity portfolios and make calls with respect to sectors, industries, and markets for both Canada and the United States. So we let the currency people do the currency side of things. But with respect to holding assets, that's why the turnover in our portfolios that we've had the great fortune of running at BMO for 13 years has an average turnover of 22%. So a lot of the currency risk goes away because we have low turnover. And quite frankly, we have a process and a discipline that picks the right stock, so we kind of hedge away just from total upside with respect to the currency side of things. So
I want to get this straight. In late June, you thought a lot of the catch-up trade in Canada had gone for now, or the potential had gone for now. And at that stage, you were saying the US market looked like it would outperform Canada for the balance of the year. So just clarify that, but you still think Canada looks like a good bet?
Yeah, so it's just a math thing. So at the end of the year, I think in local currency, Canada, when you look at the numbers, Canada will actually outperform the US, but on a relative performance basis, the US is playing catch up and will outperform the second half of the year, playing a game of catch up. At the end of the year, just in the numbers, the US ultimately will underperform relative to last year on a year-over-year basis, but over the next 5 months, US is going to outperform as they play the catch up. Remember, everyone was believing their own you-know-what with respect to the American exceptionalism trade being over. You had a lot of emotion and fear-driven trading leaving the U.S. without fundamental merit and more because of personal feelings with respect to what was happening. And anytime in investing, Andrew, quite frankly, that you use your emotions to make your decisions, just like in life, you usually make a mistake. And I think what that's shown that how and why the U.S. market is ripped back. You talk about NVIDIA this morning hitting an over $4 trillion market cap. That kind of tells a lot with respect to what's happening in the U.S. market.
You do like the look of the financial sector in Canada. Our banks index has been hitting record highs.
We do, and I know that previous to our ability to speak here this morning, you're talking about TD. TD was one of our favorite names in 2024. You know, we came out we're very, very bullish on banks in general in 2024, saying that we would look back over a several decade basis, Andrew, and we saw that anytime that the banking industry in Canada, the Big Five, whenever they over-reserve, when they put enough money aside for bad loans, anytime they over-reserve 12 months later, they outperform the TSX by an average of 25%. That's exactly what's happened this time around. No one really believed this because they thought Canada was going into a recession and housing crisis and things like that. We simply believe that the Big Five plus National are fantastic purveyors and managers of capital. They did it again. Now they're buying back stock and are going to be paying even more dividends. We've always liked the Canadian banks over the U.S. banks, and we think this trend with respect to banks in general in Canada was going to continue.
Talk to us, what are your thoughts on the US market? The Herd in the Street column actually in the Wall Street Journal says people are being too hard on Alphabet without getting into individual stocks necessarily, but what is your view on the Mag 7?
Well, we're underweight the Mag 7 and overweight other areas of tech, and it's afforded us an opportunity the last 12 months to outperform the S&P 500 in our S&P 500 product by 9 full percentage points. I think what that says is the stock market is a market of stocks, and you need to be a stock picker. I think the Mag 7 is really the new Nifty 50 and more liquidity based. When investors didn't know what to do and all of a sudden they start to see the market begin to reverse, what they do? They bought the liquidity by the biggest companies in the market, and the biggest companies are the Mag 7. With respect to Meta in general, Meta has been a darling because with respect to what they're doing operationally, cutting costs and focusing on their core businesses, and now CapEx with respect to AI, just because of the liquidity side of things, and because Meta is a stock that people like in terms of their themes with respect to liquidity and big tech in general, that's why that stock has been doing so well. We, for the record, don't own any Meta because we prefer to focus on other areas within communication services in the Magnificent Seven.
So I know you touched on this, but I want to just get a little bit more on this so-called death of American exceptionalism, where America was seen as the shining palace on the hill with its rapid economic growth, etc. And then we heard, well, people are turning away from the US. You think that was exaggerated, that seemed?
1,000%. You take a look at the top 25 companies in the world. The majority of them are in the U.S. and some of them are in Canada, by the way. And I think a lot of people made decisions based on their personal views and emotion. And I think that was a mistake, number one. Number two, just in terms of fundamentals and the diversification of the U.S. market relative to every other market in the world. You don't buy stocks because they're going up. You buy stocks because they're fundamentally sound. And the U.S. stock market and the economy, number one, is the number one economy in the world. Number two, it's the most diversified index in the world. And number three, as I said, stock market is a market of stocks and has the best companies. Just because Europe has been outperforming doesn't want to buy Europe just because it's going up. You buy Europe because there's some fundamental prowess to it. And from our lens, in terms of fundamental prowess, it's the U.S. market one, Canada two.
Give us a final thought here, Brian. The U.S. consumer, are they going to be under pressure over the next year or two? Because it looks as though tariffs, they may not be huge, but they will raise prices for some things.
So here's the misnomer on tariffs. Nobody knows whether or not it's going to be the producer or the consumer that's taking on the added cost, number one. Number two, consumer companies and the majority of companies in the United States stock market are hitting at all-time margin highs anyway, so they have some room to give. Number three, there's a kind of a rule in investing. You never, ever, ever, ever bet against the U.S. consumer. We spend money here. We love it. And you look at Amazon, it's Amazon Prime days right now. We can't wait to get on the internet machine and buy stuff on Amazon. So Amazon's been one of the better performing areas in consumer world. If you take a look at other areas like Marriott and Home Depot and TJ Maxx, and then on the consumer staple side of the consumer, Costco hitting new highs, Walmart, we're spending money here, Andrew, and you never, ever, ever bet against that.